Hey everybody. My name is Luke Robinson, and I am a business advisor here at Collective. And Collective, essentially, you can think of us as kind of like an all-in-one solution for an S corp, or a business that needs to be an S corp. And essentially, we'd handle the whole shebang, for the tax situation for your business. We'd set up your business, set up your LLC, make an S corp election, uh, handle your payroll, of course. Like that's part of the administration when it comes to an S corp. And then we'd handle your bookkeeping, any tax support you need a year round, and we'd file your business return at the end of the year. So we pretty much do the whole shebang when it comes to the business. But today, there's actually a little session occurring right now that's called a Tax Tuesday. And pretty much what it is, it's an AMA. It's an Ask Me Anything session surrounding taxes, best business practices for running the business, um, best practices for taxes, accounting, whatever I guess has been on your mind about taxes or you've always wanted to ask me now. I'll do my best to answer it. And before we get going, it's good to get a good idea to get the legal stuff out of the way. And, officially speaking, consider this information just information. Like, don't consider it tax advice. Don't consider it legal advice. The tax code is extremely complex. Some of the stuff I could be incorrect on. I could be straight up wrong on some of the things that I'm saying, or it could just not apply to your specific situation. So before you do anything, make any official action on your account or do anything with this information, it's a good idea to consult with a CPA, consult with a tax attorney, just to make sure that it fits with you. But now that we have that out of the way, I think we can go ahead and get started on some questions. And the first one is, what is an S corp? Well, that's a very good question. And obviously it's a fundamental question. And an S corp, a lot of people have, I guess, almost like a misrepresentation about what an S corp actually means. An S corp, it's not a business entity by itself. Like, funny enough, it's not a corporation. And I know the word corporation, S corp, it's literally in the word S corp, but it's not necessarily a corporation. It's a tax election. So you have to be some sort of business entity, like an LLC, like a corporation, before you can elect the S corp tax status with the IRS, like with the federal government. And the reason you'd want to do that is to save on the self-employment tax. That's pretty much the entire reason why you'd want to do that. And essentially, before you become an S corp, either a huge chunk of your earnings or all of your earnings is subject to the self-employment tax. Self-employment tax, it's a flat tax rate of 15.3%. Before you become an S corp, essentially all of your money is subject to that tax rate. So let's just assume that you're making $100,000, in your business. And when I say making $100,000, I mean netting $100,000, which means after you write off your business expenses, after you do all that, what is your net income? And let's assume that number is around 100 grand. Before you make an S corp election, like, let's say that if you're just at the sole proprietorship stage, or let's say that you've gone a step further and you've set up an LLC, you set up a business structure. Tax-wise, it doesn't really matter. Before you become an S corp, how you'd come up with your self-employment tax is you take 100,000 and you'd multiply it by 15.3%. Like, the entirety of your net income is subject to that tax rate. But what happens with an S corp election, and remember, that's paperwork filed with the IRS, like it's filed with the federal government. Essentially, what happens is kind of like an employee-employer relationship is created between you and your own LLC, like your own business. Now, you're still the owner of it, like it's still your business, of course, but for tax purposes, you literally become an employee of your own operation as well. And since you're an employee, your business will pay you a salary. It'll pay you a W-2 wage, like just like you'd receive if you work for someone else, like as a W-2 employee. But the advantageous thing about S corps is that the only chunk of your earnings in total that's subject to the self-employment tax is your salary amount. So, for example, like I mentioned earlier, let's assume someone is netting $100,000 in their business. But with an S corp, let's assume that a reasonable salary for them is around $40,000. In a situation like that, only that 40 grand is subject to the self-employment tax. The other 60,000, or like just the rest of your money, like outside of your salary, that chunk of money is considered distributions to yourself. It's not considered W-2. Like, another term people will use, like sometimes people will say dividends, like they'll classify that sort of money as dividends. But long story short, that chunk of money in an S corp is no longer subject to the self-employment tax. So in a situation like that, $60,000 would no longer be subject to that tax rate. So in terms of how you come up with the tax savings, is you take 60,000 and you multiply it by 15.3%, because that's the tax rate that you're no longer paying. And that comes out to around $9,180 that you're no longer paying the self-employment tax with an S corp. And if you do some quick math, you realize that could be pretty substantial. In that situation, just the S corp election is saving almost to around 10% of someone's net income. So it can be pretty financially advantageous once you reach a certain income level. All right, let's go on. Ooh, what are two things that most business owners don't know about S corps? That's an interesting question. In two things, not even one. One, I would say, so this is a question I get a lot. People will ask me, okay, well, if I'm only subject to the self-employment tax on my salary, then why not just pay myself a super low salary amount? Like if I'm making $100,000 in total with an S corp, why not just pay myself $1 W-2 salary, or a $1,000 W-2 salary to really limit my self-employment taxes? And my response is that if you did something like that, it would greatly increase your chances for to be audited by the government. And this is what the IRS says about the salary. The salary has to be reasonable. It's got to be a reasonable salary. And essentially, that's all the IRS says about it. Like there's no sort of official or an objective method to come up with a reasonable salary. But this is kind of what the IRS looks for in terms of when they're trying to determine whether a justification for a salary is appropriate or not. They'll look at things like, how much is your business making in total? What are similar professionals in your industry? What are they making? Working the same amount of hours with similar expertise. What are they making out in the market? Where do you live in the country? That's another big sort of indication on how to come up with a reasonable salary. So really, the best way to come up with a reasonable salary is to rely on a tax professional to use some sort of method to give you a suggestion for a reasonable salary. And by the way, that's part of collective services. Is part of the payroll processor services. When you come on board, we will give you a salary recommendation. So you don't have to do any sort of guesswork when it comes to the compliance. Collective will handle that for you. So that's one thing I would say is that the salary is very important. There's a lot of people that think the salary can just be chosen just at random, but that's not really the case. And in terms of a second thing that business owners don't know about S corps, okay, another second thing is when you make an S corp election, a business tax return comes into existence. You literally have an S corp tax return that you now need to file. Before you become an S corp, like when you're just a sole proprietorship or an LLC, everything that happens on your personal return. All of your business information, your write-offs, all that good stuff happens on your personal return. Now, when you make an S corp election, all that information goes on your S corp tax return. And that one is due before the personal return. That one's due on March 15th of every year, whereas your personal return is due on April 15th, a month after. So that's number two, is that you also have a business return when you make an S corp election. Okay. Can you pay your kids out of an S corp? Theoretically, yes. You can put your kids on payroll in an S corp, if it's appropriate, of course. And with those sorts of things, the best advice I can give is be careful, because there's a lot of people that think that you can just stick your kids on payroll for whatever reason, just for the tax benefits, and that's not really the case. Like that's not really the proper way to run things. And really, you're only supposed to put your kids on payroll to start paying them a salary if they're actually doing work in the business. If they're actually, like, for example, if you can prove it, if you've got timesheets, if you've got employment contracts, like if you can somehow just, lay out and make the case that your kids are actually employed and they're actually doing business. If they're not, if they're not actually working in the business or anything like that, don't put them on payroll. It's just not worth it, and it could get you in trouble with the IRS.